All right, let's jump right into this explainer. Today, we're unpacking the absolutely raw, no-nonsense business playbook of entrepreneur and investor Ashneer Grover. We're pulling directly from his intensely unfiltered conversations about building massive companies and judging dozens of startup pitches. So, grab a mental notepad because we're diving deep. Here's our roadmap for today. We've got 6 key pillars: the unfiltered business mindset, decoding the Indian consumer, the math of profitability, building brands through trust, the ultimate founder playbook, and finally, the next big wave. Let's get to it. Part 1. The unfiltered business mindset and why raw honesty actually wins.
It's fascinating, right? Culturally, we've somehow made English the default language for corporate meetings. But Ashneer points out that English is almost perfectly designed to sugarcoat harsh truths. You can deliver bad news in English, and it still sounds kind of polite. But Hindi? Hindi forces this raw, unfiltered honesty. It strips away the corporate fluff. And when you're in the trenches building a startup where ignoring the truth for even a week can literally kill your company, that unvarnished, brutal honesty isn't just refreshing, it's absolutely crucial for survival.
Moving on to Part 2, decoding the Indian consumer. Arguably the toughest market out there. Think about how people shop in the US. They drive to Walmart once a month, load up the trunk, and stock the basement, right? But in India, that stocking culture barely exists. Going to the local market every evening to grab fresh veggies, maybe some eggs or bread, that's a daily leisure activity. It's a social outing. So if you're a 10-minute grocery startup, you're literally burning millions in venture capital trying to fight against the cultural habit of a relaxing evening walk. It's a massive uphill battle. And Grover is super clear about this. Indian consumers are incredibly demanding. He actually calls them the most spoiled customers in the world. They want the absolute smallest size at the lowest possible price, delivered right this second, and yeah, they still expect a massive discount. To make it even tougher, you're boxed in by maximum retail price, or MRP laws. Every product has the price printed right on the label. So unlike other markets where you can easily charge a premium for a cold drink at a restaurant or for super fast delivery, in India, your pricing is strictly capped. Building a consumer business here is uniquely brutal because charging for convenience is almost impossible. That brings us to Part 3, the math of profitability. It's all about ticket size versus delivery. Let's break down the actual math. Take a successful UK grocery model like Ocado. Their average order is about £130, roughly 13,000 rupees. With a 30% margin, they're clearing nearly 4,000 rupees in gross profit per order. Pretty solid, right? Now, look at the Indian 10-minute grocery model. You've got an average basket of just 1,200 rupees. At a 15% margin, you're left with a tiny 180 rupee profit. And out of that tiny 180 rupees, you somehow have to pay for customer discounts, massive warehouses, lightning-fast logistics, and customer acquisition. The math just doesn't leave any room for actual profit. This led Grover to a fundamental rule. Every physical business has a cost of delivery. To actually make money, you need leverage. If you don't have a massive ticket size, like say selling high-margin cosmetics or pricey smartphones, you have to eliminate physical delivery costs completely. This perfectly explains why zero delivery cost models scale so incredibly well. Think about Zerodha for trading, Facebook for content, or the UPI network for payments. The product is delivered instantly, digitally, and the marginal cost is practically zero. Part 4, building brands through trust. And it all hinges on the 4-word rule. Grover has an absolute non-negotiable rule for simplicity. If you need more than 4 words to explain what you're selling, it's just not a good product. Go back to the drawing board, look at the businesses he helped build. 12% Club, you get a flat 12% return. Postpay, buy it now, post your payment later. They tell you exactly what you're getting without any confusing financial jargon. Complete, immediate clarity. So here's the playbook for building those highly trusted brands. First, solve a core problem simply, like giving a shopkeeper a payment QR code with 0% processing fees. Boom, problem solved. Second, once you have their attention, throw in an undeniable hook. Maybe through that very same QR code, you instantly offer them a business loan. And finally, this is the most important part, flawless execution. If a payment is delayed by even 5 minutes, that trust is shattered. This isn't just for fintech, by the way. By executing these 3 straightforward steps, Grover was able to outmaneuver massive, highly funded competitors just by providing tangible, crystal clear value. Now let's pivot to Part 5, the ultimate founder playbook. This is all about mindset and action. So when a seasoned investor is sitting across the table from a budding entrepreneur, what exactly turns a 15-minute pitch into a multi-million-dollar partnership? What are they really looking for? It all boils down to three non-negotiables. First, a massive market size. Banging your head against the wall for a tiny niche just isn't worth the grind. Second, a completely unique differentiator. What are you doing that the massive tech giants aren't already doing? And third, and this is absolutely crucial, a clear eventual path to making actual cash from your customers. Investors might fund your early rounds, sure, but eventually real customers have to pay the bills. If you don't have absolute clarity on these three things, your startup is going to hit a massive wall the second capital markets tighten.
He also has this brilliant take on the dynamic between founders and investors. Grover believes an investor's true job is to step in and shield founders from bizarre, unpredictable outside risks, things like sudden regulatory freezes, GST headaches, or even police issues. The founder's job is to build the product. The investor's job is to bulldoze those external roadblocks. An investor should literally never become an extra burden by constantly demanding unearned discounts or micromanaging daily operations. As an investor, you have to solve a problem. You can't be the problem. Which brings us to a hugely important psychological tool, mastering the word no. So many people string founders along with a maybe just because they don't want to seem rude, but a quick, unapologetic no saves everybody's time and gives ultimate clarity. Rip the Band-Aid off, let everyone move on. On the flip side, you have to fiercely protect your yes. A yes is a massive long-term commitment. It means going all in, standing right beside the founder behind the scenes, and taking mutual responsibility even when things fail completely. Finally, we reach part 6, the next big wave. Let's look at what's coming next.
Ashneer predicts that electric vehicles are the absolute, undeniable next wave. He actually believes the internal combustion engine is literally headed for a museum. Every truck, tempo, and car is going to be replaced. But here is the real game changer. It's not just about getting from point A to point B. Think about a small shopkeeper or a delivery driver. An EV isn't just a vehicle anymore. It's a massive mobile battery. That same vehicle can power a shop's appliances or literally run a mobile business. The utility goes through the roof. So as we wrap up this explainer, I want to leave you with this thought. When the very definition of a vehicle shifts from basic transportation to a massive mobile power station, how are you going to position your next business to ride this revolution?